Well, welcome to the Don and Gino Real Estate and Finance Show and the National Real Estate Cafe. And we have got a great presentation for you today. Let you know what's really happening in the real estate market today. Sponsored by Finance of America, of course. And we're excited to share with you what you need to know to explain to your clients what's really happening. Right, Gino?
Yeah, you know what's exciting, Don, is that when we started our radio show 10 years ago, we didn't know what guiding you to personal and financial wellness was going to mean. Well, what it turned out to mean is that we got to interview some of the absolute best professionals, economists, and business people around the nation. And we were able to learn and hone our trade so that we could understand data in a better way to help you succeed.
Well, right now, Gino, perfectly said, is everybody's worried about the market right now. There's a lot of fear out there. So how do you express what's really happening? So we put together this presentation to show you facts and figures about what's really happening in the real estate market and how it compares to previous markets and why we feel that the real estate market is actually what's going to bring us out of this recession.
I feel like a stockbroker here. Past performance does not guarantee future performance, but
You want to get rolling, Gino? So what you need to know about real estate. So we're going to walk through so you can, be a lot more articulate when explaining why the market is okay. So right here, we're going to talk about, are we in a recession? Yes.
Well, yes, absolutely. We've never fallen into a recession this quickly and this hard. This is going to be a fast, deep recession.
It's going to be like to a previous. We're going to talk about, is this like 2008? That's a big fear out there. Is this a market crash? We're going to talk about the job losses. We're talking 26 million people filing for unemployment right now. We're going to talk about where are mortgage rates heading and the good news about real estate.
Well, there's plenty of good news. So as we address, are we in a recession? Yes, we are, absolutely. Now, Q1 numbers might still look positive, just because January and February were decent. So it's very difficult to know whether Q1 is going to look good or not. But Q2, Q3, and potentially Q4 as well, actually almost for sure Q4 as well, are going to be recessionary.
Yeah, it's going to take a little while to rebound from all the job losses. But the good news is we feel that it's going to be a quick recovery. And we're going to talk about it. So this does not mean a housing crash, though. And we're going to explain why, because a lot of fear out there is, with all these job losses, aren't we going to head into a housing crash? We don't think so.
No, there's a lot of reasons why not. And here's one of the reasons is that with the exception of two of the recessions, the Great Recession, which we just went through, and the Gulf War recession, no other recession impacted the housing market negatively. And during the Gulf War recession, it was also impacted minimally. It wasn't a housing market crash like the one that we just had. The one that we just had, the housing market created and was the catalyst to the crash. That's not what we have today.
Right. So in the last 5 recessions, for example, everybody's worried about house prices. We feel house prices are going to continue to go up because we're low on inventory. We'll show that. But you can see for the last 5 recessions, 3 of them, house prices still gained appreciation. Of course, the 19.7% drop was caused by the real estate market and the housing market. So that's why it was so bad. But the rest of the recessions actually showed appreciation.
Well, let's go into that a little bit, Don. Let's talk about why it's going to be a little bit different this time than it was in 2008. We've said already that the housing market, that was the catalyst for the problem. But let's take a look at why.
All right. So, the big fear is from a lot of people have scars, including us. We lived through it.
We have big ones.
Yeah, it's from the Great Recession. And now everybody's worried about the coronavirus outbreak being the next catalyst for a market crash like 2008, 2009, but it's completely different this time.
All right, so let's take a look at this next chart. It's going to show you that after a large S&P correction of 50%, which you could say there was some similarities now, but look how long it took. It was 1.5 years for that 50% correction. This was like 1.5 months. So totally different already. And one of the things that you'll identify throughout this presentation is that the duration of the recession has a lot to do with how we recover. And you could see that we had a long recession and that the housing crash was a long, extended time.
Yeah, and quite a bit of depreciation. So what's really nice is what we've realized is this is a lot like 9/11, which was fear-based and instant. And this is very similar to that. This was fear-based and instant, and it's attacking basically the same industries. airline, leisure, hospitality, restaurants, entertainment. Sound familiar? Very
Yeah.
familiar with the 9/11.
Yeah. So let's take a look at this. Again, now you've got this large correction, just like you did in the other one, but then you've got massive appreciation. Why would that possibly happen? How could you possibly have massive home price appreciation right after a large stock correction? Well, number one, stocks were deemed unsafe at that time because it was a dot-com bust. It was 9/11. So you had this giant crash, and a safe place to be is real assets, be it gold, be it houses, real assets and not paper money.
Good point, Gino. All right, so look at the appreciation levels. Now, this is key. We're showing you why it's not a crash. There was actually a problem with 2000 through 2005. The appreciation levels were actually too high. We're talking double digits in some cases, and that was due to loose lending standards. If you see the appreciation level in the last 6 years, very consistent and very normal. The normal appreciation level is what, around 4%, Gino?
Yeah, 4% historically, Don. The other thing to take a look at is look at those numbers. That was an awfully hot housing market. So as people moved their money out of the stock market that was no longer trustworthy and they moved their money into housing, what happened is they created speculation in housing, introducing some of the volatility that we normally see in the stock market rather than in the housing market. As you can see, the last 6 years, we haven't been doing that. It's been very stable and right across that trend line that we have for the last 50 years.
Which is what we feel is going to maintain. So look at here's the loose lending standards, mortgage credit availability index. You're going to see that back in 2005, 2006, it was as high as 868. What that mean doesn't mean anything to you other than look at today. The mortgage credit availability index is down to 181. Literally one fifth the amount of availability. So people that buy homes now qualify for the homes now.
Well, not only that, Don, but because there's a lag factor, if you look at this chart, if you look at it post coronavirus, it's probably going to go back down to about 125, 130, because mortgage availability has taken a hit in the last few weeks.
That's a good point, Gino. All right, so here's the other factor is back in before the mortgage meltdown, everybody was using basically their homes like a big credit card machine, and they were taking out all the availability, all their equity out of the home, feeling that if it's going to keep going up forever, and I can qualify for more because of loose lending standards. But look at the difference. They took out all their equity. Therefore, if there was any adjustment in the market, they didn't have any equity position to protect themselves. You can see
So,
now that everybody's taking out about 1/4 the amount of equity out of their homes.
so when you look at mortgage credit availability that we just looked at in the last slide, and you look at this, the story goes together because mortgage credit, not only was it so simple to qualify for a mortgage, but you could do a cash out refinance up to 100% of the value of the mortgage. So of the value of the home. And so what that did is it set us up for everybody being upside down. Even if the market took a 10% tank, everybody was upside down. So we don't have those conditions today. People have more equity than ever right now, and they haven't been cashing out. And with mortgage availability contracting right now a little bit, that's also going to restrict it a little further. So there won't be the availability to do what we did before.
Right. I mean, look at this. I mean, now over 50% of the homes in America have at least 50% equity position. 37% of the homes are actually paid off. So there's a lot of equity in the homes right now. So we're not as afraid of any correction or a mortgage meltdown. People have, if they have equity, they're staying in their homes.
Yeah. And look, here's one of the things, right? Everybody's worried about job losses and what's going to happen with job losses. Well, if you've lost your job and you're unfortunate enough to be in one of these industries that has been severely affected, you have equity. We just discussed it. Most likely you have equity. So you might have to sell your home with equity, cash out, and go rent for a little while. Realistically speaking, that's what may happen. Or maybe you're lucky enough that the forbearance that you took helped you throughout 3 to 4 months, and then you're able to jump right back on. That's going to depend on what kind of quality job you have.
Yeah, I mean, if you have equity, you're not just walking from your home. Back in the past, in 2008, you didn't have equity. You're like, what the heck? I'll just walk. Right now, if you have equity, you're going to figure out how to either keep that home, or at least if you sell, like Gino said, that you'll be able to come out of it okay.
And that bodes well for us because we need a little more inventory. We'll talk more about that later.
Yeah, I mean, this actually we'll update this slide, but as more and more people are claiming unemployment, but you can see the numbers per week of the people that are filing for unemployment. And now we're at, I believe, 26 million have filed for unemployment, Gino, something like
Yeah,
that.
but you could tell by this chart going back to 1970 that this is completely unnatural. And so when you have something like this, you should expect an equal or greater reaction when you have something like this. So just something to keep in mind, that this is completely unnatural. And something else that makes these numbers unnatural on the unemployment report is, for the first time in history, you can file for unemployment as a self-employed borrower. So
Right.
those numbers are taken with a grain of salt, because it is not necessarily true, because self-employed people are filing for unemployment. So that should have a giant asterisk next to it and say this isn't necessarily representative if you were to compare it relatively to the last 40 years.
Good point. And this, I love this chart because this is a key factor. Now, again, like Gino said, it's very unfortunate if you've lost your job. We feel for all of you out there. We know this, there's a lot of hardship out there. Hopefully it's gonna be very short term and you'll be back to work. But as you can see here, breaking up where the unemployment is, we're talking like 59% is food service, drinking places, bartenders, servers, also retail. So you're talking 60, 70% of those that lost their jobs are not usually the highest percentage of homeowners. They're not the
Let's
ones buying homes.
let's go ahead and identify why. First of all, these are people that generally work on tips that they don't report, so they can't validate their income, so they can't get into a home. The other thing that you're dealing with there is they're pretty much, in general, and I'm going to generalize, the majority of the jobs that are being lost are low income positions. We're not losing our highest income positions. We're not losing engineers. We're not losing very, very high end jobs. We're losing a lot of the bottom, which is also going to help us with the recovery, isn't it, Don?
Yeah, absolutely. So this is another reason. I mean, you look at these statistics. This is why we feel that the housing market won't suffer. It'll have a bump in the road because those of you that don't want to go out and look at homes right now, or it's a little harder to, that'll be the bump in the road. But we feel that the housing market will rebound quite quickly.
In fact, so does everybody else, don't they, Don?
Yeah,
Uh,
look at the V-shaped recovery.
yeah, you heard a lot about a V-shaped recovery. There's also some people talking about a W-shaped recovery, which is if we have another incident of corona, a heavy incident of corona in the fall, we could potentially have another dip and then have another climb. So we're looking at either a V-shaped or W-shaped recovery because jobs are coming back. And as of this moment, we actually have a couple of states that have started to open up in a restricted capacity. And 30 days from now, we'll know how that's working out. And if that's working out, if we can make it a trend throughout the country.
All right, so here's the point that we saw. Right now we're looking at, it says 15% here. We know that we're above 18% right now in unemployment. But the good news is, like Gino said, it's the extended period of time that really affects the economy and affects the housing market. But you can see we have a pretty quick rebound to where we're going to go from 18, 20% of unemployment down to probably 6 to 8% back in 2021, depending on the coronavirus, and then down to 5 and 4%, which is closer to where we're at now. So
So
it's a very quick recovery.
two things that are interesting about this. In the week that it took us to put together this presentation, the numbers are already inaccurate.
Right.
Uh, just because it's moving so quickly. So it's going to be important for us to update this quickly. But look at 2021. And the reason I wanted to draw attention to 2021 is because it was holding at historical unemployment levels of 6 to 8%. That's where we've been historically. So if we're able to drop right back to the trend line, forget the 3.6 and the 4% that we were experiencing right before. I mean, those were unprecedented times. But if we're able to drop back to the trend line, then 2021 is the year we can pull out of this recession.
And you can see from this chart, basically we're just showing you that not always does unemployment rates have a direct relationship to home sales. And we feel that the home sales right now, we have pent up demand. We've been seeing it. We don't have inventory. In fact, we'll just show you unemployment rates that were during the Great Depression and Great Recession. Look at that extended period of time like Gino mentioned.
Well, I think that's one of the most critical things to see is the pain is felt more the longer the recession lasts. And if you look at the Great Depression, it was year after year after year of job loss and pain and jobs that never came back. It took a really long time to recover. And that's not what we're going to see right now. That's not what we're expected to see right now. And the reason is we have a government that has acted in tremendous fashion, which has all kinds of other potential repercussions down the road. But we didn't end up with what happened in the Great Recession and the Great Depression. The Great Recession is actually a better example of a government that acted slow but faster than in the Great Depression.
They didn't
And
act all in the Great Depression. That was the factor.
yeah, and in the Great Recession, they acted late, and this time they acted early and fast. So we could start to make a correlation that the faster the government acts to offset one of these cataclysmic situations, the faster the recovery and the stronger the recovery.
Interest rates. Let's talk about that. Look at where interest rates are. And the reason I bring up this chart and the next chart, Gino, is if you remember the real estate market, the end of 2008, beginning of 2019, was hampered a ton by interest rates. If you remember, it stopped. We had like 6 months of hardly any real estate transaction going on. Purchases, refinances, nothing. It had a lot to do. You see that spike where interest rates went about 5%, I think, went up almost a full percent in like a matter of weeks.
Yeah, we hit 5% over roughly 5% at those times. And let me tell you something, there's either a psychological barrier or an affordability barrier right around 4.5. So anything when you cross that 4.5, let's call it the event horizon line, from that line forward, you've got a serious affordability problem. And when it moved so rapidly, as you could see there in the chart, one of the problems was that you could literally have been shopping with an interest rate of, let's say, 4%, and you actually got into escrow, and lo and behold, you were at 5%. So now you couldn't afford the payment, or you couldn't qualify anymore for what you had just gotten a pre-approval for 3 weeks before.
So here's another example of that spike, just a little bit more dramatic, just showing that spike, and that interest rates do affect the real estate market more than prices. It does affect your purchasing power, and it affects the payment you're paying, and it just killed the market back in 2018, 2019. The good news is look where rates are at now, and we feel that they're going to maintain this low level. It almost has to, doesn't it, Gino, with all this debt that we're creating from the government?
Absolutely. So government debt creates downward pressure on interest rates. Recessions create downward pressure on interest rates. And if you look at this next slide, you'll see that Fannie Mae, Freddie Mac, Mortgage Bankers Association, National Association of Realtors, everyone is projecting, other than one anomaly there for Q1 at 4%, everyone is projecting rates in the threes. And as we talked about, affordability exists in the threes. Affordability starts to taper when you get to 4.5 and beyond. So
Yeah,
we're going to
see us going to 4%.
Sorry?
I don't see us going to 4% in the near future.
I don't think so, not at all. So I think these numbers are very conservative, and I think that we'll see more aggressive rates going forward.
Yeah, and this is the Freddie Mac chart. You can see the rates when they took that dip, and now you see the flat line. And actually, that's pretty much what we feel we're going to see for quite some time, which is going to fuel the housing market. That's what's going to create the rebound in the housing market's actually going to bring us.
So let's address that flat line, Don. That flat line exists because we're artificially creating that, right? You have the Fed that's purchasing mortgage-backed securities and treasuries in order to help stimulate an economy. So there's a saying that's called "don't fight the Fed." So the reality is that if we think that the Fed's going to continue to intervene in markets, we should be able to continue to predict that we're going to have a low interest rate environment going forward.
And they're doing a good job right now. They're actually buying just enough to keep it very consistent. Right now, what our market needs is consistency and predictability. And for a while, they actually were purchasing too many mortgage-backed securities and actually hurting our market. But now they've got to kind of figure it out, and we're keeping a very consistent line, which helps our market out quite a bit.
Yeah, like in all things, they tried to do something good. They didn't understand the repercussions, and they had to tune it a little bit. But they reacted quickly, and now we're in a good spot.
So to close out our presentation, we have good news, and this is the good news you want to share with your clients, because the housing market is, again, everybody's really afraid of where we're at right now due to the coronavirus, but we have very good news. There we go. So go ahead, Gino.
All right, so you have a few bullet points on why we have a strong housing market going forward. You have a rise in affordability due to wage gains or wage recapture, let's call it, as people get back their jobs, and interest rates. That's not on the slide, but that's a very important factor. Appreciation depends on relative price. So relative price is a factor of affordability. And as we said, the number one factor in the cost of home ownership is interest rate. not purchase price. So with a low interest rate, you're going to have a very low cost of ownership over time, leading to great wealth over time as well.
Then you have rents that are going to continue to rise. We've always seen that, and they always do. Even during this time, you're going to still see rents continue to rise. And then,
Sometimes
yeah,
take a little tiny flat spot and then they go back up.
exactly. And then we still have historically low inventory. We have had that, you know it, your clients know it, and it's going to continue that. We didn't build homes for 10 years, bottom line, and people were still having babies. So we still have a lot of catch up to do regarding building home building. So we have low inventory. That helps escalate prices and keeps prices going up.
Well, it's the most simple function of supply and demand, Don. At the end of the day, if we don't have enough supply, we'll continue to have demand. It'll continue to fuel prices as far as home appreciation. It should continue to do that because not only do we have, I mean, in some areas we had gotten down to 1 month of inventory. It was actually an
Right.
inventory deadlock, which creates all kinds of problems. So I'm going to say that in a very odd sort of way, this might be the breath that the housing market needed in order to keep climbing. All markets can't go up linearly. They need to have corrections and then they continue to climb. And this might be that correction.
Well, look at this chart, Gino. We're talking about inventory levels. And back before the mortgage crash, look at how many homes were available at that time. 3.8 million, where the average is 2.5. And today we're only at 1.9. We're actually below the average amount of inventory that's out there. And like you said, in certain markets like Los Angeles, we were down to 30 to 45 days worth of inventory. I mean, in our community, we have 300,000 people in our community. We had 300 homes available at one point.
It's absolutely a sad state of inventory. And as the builders were starting to build, then we run into this, which will slow it down a little bit. So that'll continue to be a little bit of an issue. So here's something interesting, right? We always think of millennials, and I don't know what you have in your mind as millennials, but for many years it was millennials are kids, millennials are kids, millennials are kids. They're not now. They're in their prime earning years. They're in their 30s to 40s. You'll see that the oldest millennials turned 39 this year. And one of those things that's interesting is they got to get out of the house. How long are you going to live in mom and dad's house? So you got to get out of the house. And there's other factors that are also going to fuel why we need a little bit more housing as we create more homes.
This is the ballywag, huh, Gino? I mean, you're talking about the millennials or anyone, basically. You can see that the home ownership level when living alone is 38%, but as soon as they get married and have children, it jumps all the way to 80%. And now they're in those prime years right now, like Gino said, of getting married and having children. And then you want to own a home. So these are prime years. So the millennials are coming. They are going to be for quite some time.
So one of the things was millennials do all the same things and want all the same things that everybody's always wanted as far as other generations, boomers, Gen Xers, and everything else. They just had to do it later because of the Great Recession. The
Right.
Great Recession and technology and other factors postponed their ability to do this, but they still have the same wants and needs. And it's amazing when you look at that jump. So the number one most important thing in order to drive housing and creation of households is being married and having a child.
Right. Well, and then here's the timing. I love this chart. The Google search terms, and you can see in 2008, baby registry and wedding registries weren't that high, but look at the numbers as of 2018, 2019. Huge jump in the search terms for wedding registry and baby registry, which is the big ticket. And now we have the coronials coming.
We do. We do. So, if it's true that we anticipate that this quarantine is going to bring on the coronial birth boom, and that's going to happen, say Q1, approximately Q1 and Q2 of 2021, you could start to project that homes are going to get purchased at a higher rate based on the chart we saw before this in Q1 and Q2 because people are going to get married and have babies, or they're going to have more babies.
Yeah, good news for real estate community for sure. All right, so here's more good news. I'll let you touch on this one, the GDP.
Okay, great. So this chart actually is showing the Q1 GDP in contraction. I'm not sure if that's going to happen as of yet, but look at Q2. Massive contraction in Q2. Absolutely massive contraction in Q2. And I think that's a little aggressive for Q3. I think that Q3 actually might be a little worse than that. but Q4 is probably in line, Q1 is in line, and Q2 is in line. So what you're seeing represented here in numbers is the V-shaped recovery that everybody's discussing. And if you actually look at Q3 and Q4 of next year, you see that it softens a little bit as the economy starts to stabilize, and Q3 and Q4 of 2021 start to look a little more like Q1 and Q2 of 2019.
Right. Well, here's the good news. And I know these charts are a little, a lot of data in it, but the key thing that we want to represent, this is Mortgage Bankers Association's projections for the next few years. And this is great news for all of us and why we feel that this is going to continue. You're looking at, let's just go to the middle slot, the middle row there, home sales. This is what's key. So we had 5,200 up to 5,400 home sales in 2019. And then you're going to see that dip in Q2. It drops all the way down to 4,800 homes. And then it starts to pick up a little bit in Q3. But look at the numbers as we move forward through 2022. They continually rise. Home sales rise for the next few years. And that lower chart at the bottom, look how consistent interest rates are. That's really what's going to fuel the housing industry, is consistently low interest rates.
Yep.
We're
So a
actually,
lot of
the
times you look
affordability is
at
better than the 70s right now.
Yeah, so you look at a lot of times you look at unemployment as the catalyst or the thing that you could look at to see where the economy is going. This time, I do believe you're going to have a low interest rate fueled recovery along with government intervention to prevent deflation. We do not want deflation. Deflation is a scary thing for governments. So you will see them trying to inflate the markets as much as they can. They're going to do that through low interest rates and through other forms of intervention.
So the good news at the end of all this, hopefully you got some great content to share with your clients. And the fact that bottom line is this, we're heading into what we feel is going to be one of the biggest housing booms we've seen in quite some time. And we want to make sure you're prepared for it.
Yeah, so take advantage of the opportunity. Remember that in all crises, there's opportunity. And if we invest like some of the best investors of all time, like Warren Buffett and others, they take opportunity where there's fear. They buy when others sell. They do things, I think it was Baron Rothschild said, when there's blood in the streets. So just make sure that you understand that with every crisis, when there's fear, which is false evidence appearing real, there's also opportunity. So if you're able to take advantage of that opportunity, then we'd love for you to be in the housing market.
Yeah, we're very excited and we're prepared. Our company's prepared, and you should get prepared. That's hitting your database, that's getting in front of your clients and being prepared for one of the best housing booms we're going to see in quite some time. Well, we thank you for being part of our show. Hopefully you had some great data to share with your clients and make them feel more comfortable about the housing market moving forward. Right, Gino?
Absolutely, Don. And remember that this October, maybe August through December, is going to create probably the best opportunity that we've seen, with a slight price depreciation or some sellers that have to sell, and the lowest interest rates we've ever seen. So there is a window of opportunity that's going to come Q3 and Q4 of this year. And I think that that's a great time if you're a long holding real estate investor like we are. We think that's going to be one of the best opportunities to buy investment property going forward as well.
All right, and make sure you can always find out more information. We're going to continue to share with you as much information we can as we disseminate all this information coming across. You can always go to donandgino.com, or you can go to the National Real Estate Cafe, nrecafe.com, and we will post the videos on a regular basis. Subscribe to our YouTube channel, and we'll keep you in the know, and we thank you for being part of our show today. And stay safe.
Have a great day.
We'll update you as soon as we get more data. Again, donandgino.com.